Financial Stability Symposium is one of the critical engagements aimed at meeting Bank of Uganda's objective of enhancing stakeholder confidence. The key purpose of the symposium is to increase awareness, understanding, and appreciation of BOU's financial stability analysis and policy recommendations. It is therefore our hope that at the end of this symposium, we will attain two main objectives. Firstly, explain the Bank of Uganda's financial stability mandate and provide accountability for our financial stability policies and actions. I want to emphasize that maintaining a sound financial system is one of BOU's key mandates. As you're all aware, Bank of Uganda supervises and regulates financial institutions, including commercial banks, credit institutions, microfinance deposit-taking institutions, and forex bureaus to ensure that they all conduct their business safely without compromising depositors' funds. If they fall short of regulatory requirements, Bank of Uganda ensures prompt corrective measures to safeguard the sector's stability. Secondly, today we aim to achieve, and I think this is the more important one, to receive feedback on issues pertaining Bank of Uganda's financial stability mandate from you, our stakeholders. I must point out that from our previous engagements such as this, the Bank of Uganda received meaningful feedback that is continuously being incorporated into the bank's strategic initiatives. As such, we have chosen to keep holding such engaging events, and your active participation will be highly appreciated.
Financial stability point of view, there are a number of risks that we tend to focus on. Major risk groups, not risk subtypes, but major risk groups. And if you look at the slide, I think slide number 2 or number 3, where we have a summary of key risks. So overall, the risk rating for the economy from a financial stability point of view is medium and stable. But then that is subject to a number of caveats and conditions. We are seeing steady recovery in domestic economic activity. We're seeing that the number of banks, or the majority of banks, and also in aggregate, have got strong capital buffers. And at this time, despite slight tightening of monetary policy at the last MPC, the effects of the pass-through of those effects are yet to come through. So for now, it's amber and stable. The outlook is strong economic growth and increased market stability expected to drive improved liquidity conditions for the banking institutions. Also, and this is largely on the back of the fact that most financial institutions hold sufficient liquidity buffers to meet short-term obligations and absorb potential liquidity shocks. So for those who had been worried about the Bank of Uganda bumping up the minimum paid-up capital at the end of 2022, you begin to see some of the things that we saw then, because now the institutions are going to be in a better place to absorb any shocks, or at least the shocks that we expect to see over the medium term. I also like to draw your attention to table 1, which is at the bottom right of your slide, of the slide. And just take a look at the average spread on the interbank rate versus CBR, the average spread on the FX swap. You'll notice something quite consistent here. For the spreads, on average, there tends to be between a 20 to 30 basis point increase. The interpretation of that is entirely up to you, but for us, it has potential implications for liquidity, and hence the concerns, not yet elevated, but the concerns that we have over funding and liquidity over the medium to long term. And when you look at the liquidity ratio, that has remained more or less constant. So especially for the treasurers in this room, I would like you to draw attention to this particular slide and just begin to appreciate that whilst we are stable, whilst we appear resilient, we see some dark clouds over the horizon, unfortunately the majority of which we don't think we even have control over. So they say forearmed is forewarned. So it might be necessary for institutions to go back and just look at how they are planning to manage their liquidity over the medium to long term. Credit risk. Credit growth, especially measured as PSC, which is private sector credit growth, remains below its long-term trend. The outturn for end of March was 6.7% versus a growth target of 13%. So that is a significant underperformance. And when you look at the slide, on the top right, on the same slide, the figure on top right, it talks about Uganda's private sector growth as to GDP for the as a ratio. You'll notice that where the solid line represents the long-term trend for PSC as a ratio of GDP, actual credit to GDP, the gap is measured in the green line represents that. And you'll notice that while it appears to be more or less constant, there have been, you notice there have been some ups and downs in the past, and this is smoothed out. But if one was to look at on a more granular level, we expect to see some further bumps going forward over the medium term. Like I said, credit growth has slowed. Now, if you look at the average weighted learning rates, those have also gone up. Now, partly it's because of tightening, but we also think it has something to do with risk averseness within the economy and uncertainty about where we'll be over the medium term. Your assumptions as to where the origins for those uncertainties probably will range from the way government intends to fund its activities over the medium term, expectations or the implications of the World Bank, review of their lending to us, and the fact that there are certain obligations that we have as a government and certain that are coming due over the next 2 to 3 years, for which perhaps one would say funding is not yet quite certain how that's going to be done. So I mean, it's only prudent that then exposure to high risk investments like private, exposure, increasing private sector credit for the financial institutions, you kind of have to, ease on the accelerator, not to say slam the brakes, but while you figure out and try and understand where this whole thing is going. Now, however, of course, then the question then becomes, but if that's the case, how come there seems to be an uptick in lending to households and real estate? We don't have any firm theories in terms of why that is the case, but we are hoping that with some of the interactions that will come out of the household survey by UBOS will help us understand what's driving this. Perhaps is it that real estate is being seen as a possible safe haven or safe asset for households or for household income? We're not very sure. On the next slide, we'll see on credit risk. Asset quality has started to deteriorate, which again is not really quite surprising because, like I said, considering the forbearance that was applied to asset valuations during the credit relief measures during the COVID period, we expect that with a 1 to 2 or 3 year lag, the final impact in terms of actual NPLs will begin kicking in. However prudent the banks have been, we expect that now increasingly some of those firms that had managed somehow post-COVID to be able to manage, If the conditions, the uncertainty around the economy remains as it is, we expect that some of these farms are going to begin to struggle. That's one. Two, and part of the reason that motivated the increase in the base rate, the last Monetary Policy Committee, there are all these expectations or rather sentiments about where inflation is going. And inflation tends to be a driver, especially for import-based economies like ours. When you have inflation that's largely imported, and capacity of aggregate demand not growing as fast, then performance of borrowers who are largely in the sectors that are reliant on imports tend to suffer.